they've lied to all of us and said, save your money, put it in a bank account that's safe, earning 0.25% APY. What's actually happening is they're stealing your time. The actual inflation rate is like 8 to 10% a year. The S&P earns every year, I'm sure maybe some of you guys have heard this, is like 8% a year. And then you kind of put the two together and you say, wait a second, the S&P's growth is just inflation.
Pay increases are not going up in line with inflation. College prices have like doubled, tripled since we graduated. Things are just really not looking good.
My parents lost their home. My grandmother lost her home. That was a tough period for the family. And so then I started studying of like why that happened and how is the system designed. All of that led to sound money, which led to Bitcoin.
You framed Bitcoin as this generation's generational wealth play. Gold for grandparents, homes for parents, Bitcoin for us.
Bitcoin is a sponge for inflationary pressures. It appreciates in dollar terms faster than inflation.
Not holding Bitcoin is becoming irresponsible for corporate treasurers. That's a really big claim.
I stand by it. It's less scary if you take the time and understand how the system works. And so if you get educated about that, well, just like anything, right? If you understand it, there's a way to address it.
Welcome to Stacked, the show that helps you become your own best asset. Because in case you missed it, you're allowed to have a high vibe and a high net worth. Welcome back to Stacked, the show that helps you become your own best asset. Today, we're talking about the deals that are quietly putting Bitcoin onto the balance sheets of corporate America with Christian Lopez, Managing Director and Head of Blockchain and Digital Assets at Cohen Company Capital Markets. Christian holds a Bachelor of Science in Finance from the University of Illinois, Urbana-Champaign, and an MBA from Colombia Business School. He started his career at Guggenheim Securities, then Broadhaven Capital Partners, and joined Cohen Company in 2021, where he built the most prolific Bitcoin investment banking team in the country. Hashrate Index has named him the #1 investment banker in Bitcoin mining 3 years running. He also personally advised Anthony Pompliano's $1 billion ProCap Financial public listing, Adam Back's Blockstream $125 million convertible offering, and the largest Bitcoin mining infrastructure deals in the United States. We will keep it 101 and practical, how the deals actually get done, the consolidation wave he's calling next, and why he believes Bitcoin is this generation's store of value, the way gold was for our grandparents and homes were for our parents. Christian, are you ready to get stacked?
I am. I'm very excited. Thanks for having me.
Thank you for coming on the show today.
Happy to be here.
So to give you guys a little bit of context, it is Consensus Week in Miami. It's a big digital asset conference. We're coming off the tailwinds of Bitcoin Vegas, which was last week. It's early May, and we are sitting down here with Christian. So Christian, our show is definitely a little bit more 101 and entry level than I think a lot of the media that you do out there. So I always love to get started just kind of diving into your backstory, how you grew up, what your life was like pre-crypto, because everybody has a story and a pivot of how they kind of got there. So your ex bio reads first generation American, first generation Bitcoin adopter. Walk me through where you grew up and kind of what shaped your early years.
Yeah, you did your research, and I definitely appreciate that. So my background, I come from an immigrant family. Family is of Colombian and Spanish descent. I was born in Texas, kind of right after my parents immigrated to the United States. And, typical immigrant story. Dad started a Colombian restaurant. Mom eventually became a stay-at-home mom, and they did what they could to put me through education. So I always kind of had that, that feeling inside that, hey, they moved here, kind of left everything at home, left family, et cetera. So I need to prove myself and make sure that I do right by them. So that's kind of where my pursuit of finance kind of came about. Fast forward to when I ended up going to the University of Illinois.
So I'm from Chicago originally.
Yeah,
we talked about this on the phone. So how did you go from Texas, and where in Texas were you guys?
So we were in Dallas,
Okay.
in Dallas, Texas. I was born in Plano, but Dallas is right there. Half my family is still there. My dad's side is still there. Me and my mom moved to Illinois, where her mom was, my grandma. And there was a few family members out there in Chicago. So then we stayed there, and mom remarried, and that's kind of how
That's how you ended up at
in
UFI.
Chicago. That was like 5 years old.
Okay.
But I kind of consider myself from Chicago versus Texas.
I love that.
Cubbies
Follow
fan.
Midwestern. Yes, go Cubs.
Go Cubs, Bears, Bulls, all the way. Cubs are having a good season right now.
I'm going to have to start paying attention to Chicago sports again since I moved to Miami, where it's not like a big sports city here.
It's kind of sad.
New York, Chicago, we love our sports.
Awesome.
Yeah.
Awesome sports town.
Cities.
And the Bears are going to be really good this year. Hopefully. Then University of Illinois I matriculated in 2005 into U of I. And as we know, probably both very well, kind of graduated into the GFC, the Great Financial Crisis, where there was a big mortgage crisis, massive debt issue across the United States and globally.
Impossible to get a job.
Very hard to get a job. I graduated in 2009. So that was a pretty tough market. I got really lucky securing a job with UBS in London.
Okay.
After my
oh wow, they shipped you right off to London out of college.
They shipped me to London.
That's a big deal.
Yeah, it was cool. I felt cool going to London, working in finance in one of the world's financial capitals. But it wasn't easy. A lot of interviews and a lot of no's to get to that UBS role. But really fast forward, like how I got into Bitcoin, and I won't go too deep right now, is reflecting on that great financial crisis period, right? My parents lost their home. Actually, my grandmother lost her home as well, just caught up in the madness and in taking out additional debt on homes that were definitely overvalued under adjustable rate mortgages that they couldn't necessarily meet payments for. And that was a tough period for the family, obviously got through it. And so then I started studying of like why that happened and how is the system designed. And all of that led to sound money and gold and inflation, which led to Bitcoin.
But you did not get into Bitcoin back in, that was not when your interest kind of peaked.
I wish I had.
I think we all wish we had.
Yeah.
All right. So you go to London, you're in investment banking at that time, and you kind of continue on your career. And then Cohen Company happens in 2021. Yeah. When was like your first signal on Bitcoin? What kind of like piqued your interest?
Yeah. So was UBS, then worked at a small pension fund right after UBS. But then that's when I pivoted into investment banking, having gone to Columbia Business School to make that pivot. Then I went to work at Guggenheim, working in the fintech and financial services team of Guggenheim. There, I was introduced to the blockchain and to Bitcoin and Ethereum and kind of decentralized finance and how Bitcoin is kind of the next world store of value. At the time, it was still more of a peer-to-peer payments play versus an actual store of value that has evolved, obviously. Made my first Bitcoin purchase, my first ETH purchase with like a group of buddies at work. And it was nobody knew what we were doing. It was for us like fake money. It was like the next meme stock really at the time. Did okay and, kind of forgot about it after the 2017 bubble bust, but kept working in investment banking, kept working in fintech, and was at a shop called Broadhaven Capital Partners that was very specifically focused on fintech and market infrastructure. So like exchanges, right? Stock exchanges, alternative trading systems, which are known as ATSs, trading shops, FX shops, payments, and digital banking. Really fintech infrastructure. And there, through the deal flow that we were seeing, we sold a derivatives exchange, a crypto derivatives exchange called ErisX to Cboe, which is a large US exchange. And then we helped raise a Series A for a company called R3, which is a private blockchain infrastructure provider. And then there, I realized, wait, this is a really cool technology that has the possibility of changing the entire fintech infrastructure ecosystem.
Mm-hmm. So this is like pre-2020.
Yeah, this was like 2016 through 2020.
So I'm so curious, what kind of players were you seeing in the space? Obviously, you were like in a very traditional finance role, but the products you're working on and selling and raising money for are totally like very alternative at that time, and that the industry was nowhere where it is today.
Yeah.
So what were kind of like the characters like?
Well, so I was 99% of my deal flow was more traditional, right? Because it was the blockchain and crypto was so new. There just weren't that many deals to be done at the level that, we're at in terms of investment banking. We usually help middle stage or late stage companies with capital raising, going public, or M&A. Whereas at the time, the industry was super nascent and there was a ton of VC capital coming into the industry. That's like Series Seed, right? Which means early stage, very, very early stage companies, Series A, Series B. And there was the ICO craze back then, which I'm happy
What does ICO mean?
An ICO stands for initial coin offering, which is like an IPO in traditional stock markets, which is initial public offering. It was just a term derived for the crypto industry, to basically tell the world, hey, we're launching a new token. But 99% of my work was traditional investment banking for payments companies, exchanges, et cetera, like I mentioned earlier.
Then now we get to 2021. So you joined Cohen Company as a VP. 4 years later, you're managing director, running the #1 investment banking franchise in the country. Walk me through the bet you and the firm were making that bulge bracket banks weren't.
Yeah, great question. And we love this question because it's kind of where we made our bread and butter. So the firm was launched by a gentleman named Jerry Srovic, who spent his career at Bear Stearns and Wells Fargo running the equity syndicate desk. Himself has probably done over 2,000 plus public offerings.
Wow.
Whether SPACs, IPOs, direct listings, reverse takeovers, RTOs, and then all the capital formation around that. So super experienced. And he was working on a product called SPACs, special purpose acquisition companies, which are just an alternative path to going public versus going down the IPO route. And I'm happy to also double click on that at some point.
Let's double click on that.
Okay.
I like that term.
Yeah. SPAC. Okay. So yes.
What is a SPAC?
A SPAC is special purpose acquisition company. And it is effectively a shell company that's put out into the public markets, a clean shell company that raises capital with the intent of acquiring a private company to take public. Right. So it's just another, sometimes people call it a, backdoor IPO. It is it's also technically a reverse merger, but just really distilling it down to its basic, what it is it's just another path for a company to go
in a very clean way.
In a clean way that really allows the issuer, meaning the company that's going public, to really drive its own narrative and allow it to access the public markets on its own accord. When you compare that to an IPO process, that is really held captive by the bulge bracket banks, right? Like the Goldman Sachs, the JP Morgans, the Morgan Stanleys, who will determine whether they really allow you to go public or not, because there's a huge queue, a huge line of companies that want to go public, and they'll tend to prioritize the larger cap, big names out there like the SpaceX, right? So right now, everybody's talking about the SpaceX IPO, and that's where all the big bulge brackets are focused. Anthropic, Databricks, there's a ton of these, big names that are out there. But if you're a medium-sized company or even smaller sized company and want access to the public markets, it's very, very challenging to access the public markets through a traditional IPO.
So a SPAC is almost like a decentralized way, or I don't know if easier is the right word, but an easier way for a smaller company to access the public markets versus traditional IPO route. You have to be the big, hot, sexy, flashiest guy in the room to really get the attention of the teams that need you to get it done.
Yeah. I mean, yes. I think you captured the essence of it. Not decentralized, right? Because it's still being driven kind of by the advisors, the lawyers, the bankers that are around it, but definitely a smoother, easier path than an IPO.
All right. So Hashrate Index named you #1 banker in Bitcoin mining 3 years running. Your team was book runner on the Gemini IPO, advised Anthony Pompliano's $1 billion ProCap listing, Adam Back's Blockstream raise, and closed the biggest mining infrastructure deals in the country. Now that some of these miners are pivoting to AI data centers, what do you think changed between 2022 and today? And there's like also a lot of other stuff I want to unpack on this question.
Oh, yeah, I love this. So we actually, like when we launched the crypto team, the crypto coverage team, it was because there was a massive blue sky opportunity there. And, I came to Cohen to lead the fintech practice. So I was kind of going to do what I was doing at Broadhaven, but for Cohen. And there was, at the time when I started there, I was like the fourth person there. Right. And we're at like now close to 40 bankers, and like the whole Cohen umbrella is maybe 120, 130 people. But the idea was, hey, let's start a fintech practice. And I quickly said to Jerry, we kind of talked, right, like what opportunities are there out there? And we had actually, Jerry brought over from his prior firm a deal called Cypher Mining, which is now one of the most well-known Bitcoin miners that has transitioned to AI infrastructure. Mm-hmm. So like if you ask the Cypher team right now, they won't tell you they're a Bitcoin miner. They're like, hey, we're digital infrastructure, high performance computing infrastructure provider, which is great. Like that's how they've pivoted. And that's kind of the essence of your question. We'll get into it. But really the idea was, okay, no one's covering this space, meaning none of the bulge brackets or traditional investment banks, because Bitcoin was a bad word. Like crypto is a bad word. And at the time you ask anybody, Wall Street, they turn their back on crypto saying it's for, drug dealers and the bad guys and money laundering. And it's like, they didn't really take time to understand it, because actually on Bitcoin, it's on the blockchain, it's public. You can trace all this stuff, and barely any of the bad guys use Bitcoin anymore to do their dealings. Right. And I mean, I don't know the number, but maybe you could pull up this stat. I don't know if you guys have the ability to pull this stat up on your podcast, but the amount of money laundering that happens in US dollars.
I've seen this
globally
stat before, and it's like, I think the US dollar is the number one place it happens, not actually Bitcoin or the cryptocurrency markets.
By multiples. Yeah. So it's a pretty funny thing that they use to try to downplay Bitcoin and crypto, but it worked, and whatever. We can touch on that later. So we said, okay, there's real people building in the space.
Nobody's helping them. There's a huge opportunity.
Yeah. And they need advice, like M&A advice and access to the capital markets, just like somebody in healthcare or energy. So we decided to, take on the space. I, packed my bags and went to Miami for Bitcoin 2021. Started shaking hands.
Yeah. So we actually talked about this when we had our intro call last week. My first Bitcoin conference was 2022 in Miami. And I feel like it was the whole focus of that conference, 2022, was mining. Every single booth was mining rigs. This is when hydrocooling, actually, I don't even know if hydrocooling was a thing yet. I think it was all immersion. There were a ton of immersion products there. It was all about mining. And that was my kind of first professional introduction to the space. I hadn't been to any conferences yet or really explored. But yeah, so mining was kind of the beginning of this whole digital asset focus for you.
That's right. And I remember from our conversation that you dabbled, you and your family dabbled in Bitcoin, which is awesome.
I went deep on mining, which is my whole nerdy side people don't usually realize. I was actually on a panel last night. We had an interesting conversation about mining. So I'm going to ask you some of the same questions, but for you guys listening, if you're not aware, my dad got into the Bitcoin space pretty early on, and over the years he dabbled in different types of investments, and I started kind of pulling back the curtain on what is he doing. He's always very early on technology, but I'm like, what is going on here? So he was hosting, which means if you are mining, you can either set up your own mining operation and manage the whole thing yourself, or you can effectively you're Airbnb-ing, or you're renting an apartment and you store your miners in somebody else's facility and you pay them a fee every month and they do all the mining. They take care of all the computer technology, they take care of the technology. They keep your computers clean and running. So that is called hosting. So he was hosting, and I start looking at the numbers and I'm like, wow, you're giving away a lot of money to the person hosting. How can we kind of take over this, and can't we just do it ourselves? So that led me down this rabbit hole of looking at over 50 mining sites, underwriting them. So at the time I was working in commercial real estate. So I was like on this mission. I'm like, surely there is a way to connect real estate to mining. And nobody was really doing this at the time. A lot of the mining facilities they were like totally like jerry-rigged operations. It would be like somebody plopped down this kind of like ghetto warehouse situation and put some computers in it and got access to cheap power. There wasn't really like a rhyme or reason for anything. So I ended up looking at on-grid opportunities, off-grid opportunities, stranded natural gas. I met with people who were mining Bitcoin off cow manure. They would capture the methane and I looked at literally every possible scenario you could look at, multiple states, multiple countries. But we ended up not moving forward with mining because what we kind of ended up getting stuck on, and this may change in the future, but when Bitcoin is mined, it's taxed as ordinary income, which I'm sure you're very familiar with all of this. So it's not treated as a natural resource the same way gold is. So when you mine gold, you don't pay tax on gold when you mine it and take it out of the ground. You pay tax on it when you sell it, which creates a whole different waterfall effect of, the economics behind Bitcoin mining. So back in 2021, 2022, it was very profitable to mine Bitcoin. That's why we saw this huge rush of people doing it. And I guess let's talk about, some of your experience taking those companies public and the economics of 2021, 2022 to where we are today, and why we're seeing a pivot on these publicly traded mining companies away from Bitcoin mining and now into AI data centers.
Yeah. Well, first of all, it's really cool that you looked at 50 plus opportunities and diligence, a lot of them. That's more than a lot of people, right? So it's awesome. And you saw like different like energy sources and whatnot. I'll say you kind of came into it right when the large commercialization and industrial mining started to take off. Yeah. People were doing Bitcoin mining from their CPUs and Raspberry Pis, like as far back as 2011, 2012, when mining Bitcoin would equate to like 50 Bitcoin or 25 Bitcoin every 10 minutes, yeah, which is crazy. And how some people accumulated thousands of Bitcoin. But that period of time, 21, 22, is when the capital markets, by the way, like the macro, you got to think about the macro environment at the time as well. Okay. Interest rates were super low. We're coming out of COVID. And so the central governments around the world, including the US, injected liquidity into the entire market in order to prop up the economy because things shut down. And so that money was flowing like crazy. Borrowing rates were super cheap. And where does money go when it's super cheap? It kind of goes higher up the risk curve. And so there was a crazy amount of SPACs that took companies that maybe shouldn't have gone public. Also with IPOs, VC deals in the private markets were stupid valuations that today are causing issues for those same companies who are looking to do deals and find liquidity or trade via M&A or IPOs. Like they can't because their valuations don't make sense. They've come back down to earth and they have huge cap table shareholder issues that they can't get by. But at that time, that's when money was flowing like crazy. And money was cheap, right? And they were what was really happening, if you double click on understanding how money works, they were devaluing the dollar. And so that, more money supply in the ecosystem means less value per that supply, in this case, dollars. And so those dollars are just chasing real assets and trying to chase returns in order to beat that inflation that dollar itself is actually creating. And so, Bitcoin mining was this cool new idea. Institutional investors had never heard of it. right? Because they're like, Bitcoin, we've heard that's weird, right? But now you have some serious people that are now being advised by investment banks.
Putting lots of money, like big
Tons.
money.
We raised on the Cypher deal about $400 million in a pure pipe for what's known as, at the time, a greenfield mining opportunity. So it was an idea.
Let's pause. What is greenfield mining opportunity?
So really, greenfield, brownfield is a terminology borrowed from traditional mining used in Bitcoin mining as well. Greenfield basically means it's a new project. It hasn't been broken in. The ground
new
hasn't.
Development.
New development. I think maybe, I don't know if they use it in real estate.
They use it in commercial real estate.
Okay.
So it's like literally a blank slate, like a plot of land that maybe somebody is convinced there's cheap power there. It's not necessarily proven.
Correct.
It's a very risky deal.
Exactly. Or there's oil in the ground, or there's, lithium there. It's a green, but the grass is still there. So it's greenfield. So really brand new opportunity, $400 million on a greenfield. And that's, like today.
How many megawatts was it supposed to be? Or was it?
I think at the time it was probably like maybe, they had a big plan to expand. So we sold the idea and the plan. And by the way, they've achieved it. So like kudos to the Cypher mining team, who's got in my opinion, one of the best power teams in the space, not just in Bitcoin mining, but in digital infrastructure. But they started off with like 30, 40, 50 megawatts and raised that $400 million on the back of that.
So interesting. And now fast forward today. Do you know what the power costs they had? Do you remember what they were?
Yeah, I think it's public now, but it's something like 3.5 cents.
It's really good.
It's really good.
Yeah,
and it's part of, their power strategy. They had some behind the meter agreements, some front of the meter, but they were able to kind of dial power back and off and on when required in order to optimize for power efficiency.
Which, you guys listening, this is what actually makes Bitcoin mining green and arguably friendly for the environment, because it helps balance the electrical grid. So in a place like Texas, where energy is kind of all over the place, depending on the time of the year, is it, summer and it's hot out? Did a cold front come in? Households, businesses are using different levels of electricity. So it's very inconsistent. It's almost kind of like a roller coaster. And where Bitcoin mining comes in, or AI, or, any of these technologies come into play and actually help balance the electrical grid, is they will commit to paying or balancing the load. And it actually helps stabilize the electrical grid, because the electrical grid can't just turn on the power and turn off the power at the flip of a switch. That's just not how electricity works. There has to be a stabilization of energy in order to consistently deliver the same quality and level of power to households and businesses. So Bitcoin mining, because it does not have to be on all the time, they can turn it on or off depending on the needs of a municipality. It helps stabilize the grid, and it's actually arguably a green and friendly way to help stabilize energy in the world, which that's a huge misconception that mainstream media loves to put out there.
You nailed it. It is I don't know who or which lobby went after the Bitcoin mining industry, and this is just putting my, tinfoil hat on, like maybe the bank lobby who saw Bitcoin as a threat to the US dollar. I don't know, please don't, cite that or source that. But it is, especially in places like Texas, California, where there's huge swings in energy and power and heat. Bitcoin mining serves as a sink or a load of power when that's needed. And it's actually, there's a gentleman, I think it's Daniel Batten, and maybe we can correct that at some point, who has done a ton of really positive research for the industry, backed by data that has shown time and time again that Bitcoin mining actually is a net positive to the energy grid.
Okay, so now today, what are we seeing with all of these publicly traded mining companies? Why are they pivoting into AI?
It's a little bit of a sad story if you think about it from the perspective of Bitcoin, but it's the right thing to do from the perspective of generating value for shareholders, and also just the better use, I think, in my opinion, of capital and energy. So the reason everybody's pivoting into what's HPC, high performance computing, or AI from an economics point of view is simply because the energy input is more economical in its output than Bitcoin mining's input. So for 1 megawatt of energy, and I'm going to butcher the numbers here, but you're going to get like $235 per megawatt hour, if I remember the last correctly, in HPC AI versus like $40 in Bitcoin mining today. And I think that number is actually lower right now. It's probably more like $35 per megawatt hour. So you're talking about like, a 7 to 10x difference in revenue and margins, because that just all flows to the bottom line.
So you're a publicly traded company. You're not going to say no to making 10x more dollars. You have shareholders to report to, you have quarterly earnings, you have, a lot more on the line.
100%.
What do they have to do now to convert like a Bitcoin mining facility? Say it's, a gigawatt or it's a massive facility. What kind of capital outlay does it take to now pivot away from Bitcoin mining and into?
Massive amount of capital outlay. And it's not just the Bitcoin miners that are converting their grid or their, installed power into HPC AI. It's everybody. Anybody that has access to enough power that makes it attractive to folks who are consuming data from GPUs, not just for AI, right? Like edge computing, inferencing, yes, like the learning as well, are trying to monetize this. And like, just for your listeners out there, the number one constraint in the infrastructure market today is energy. Because what is truly scarce is land and power. And it takes years to build scaled energy infrastructure, talking about 7-10 years for a brand new build. And then, if you need to add to existing, that's a little bit less, but there's a ton of things to consider. That energy infrastructure includes fiber optic cables that you need to connect to the population centers, because otherwise it's useless. Power distribution units, right, which are basically like your plugs, right, like your extension plugs where you put in your, all your devices, but in a much more industrial scale. Transformers, substations, power lines. There's contracts between like state utilities and regional utilities and the distributors and the consumers. It is a massively complex ecosystem in the United States, definitely globally, but especially in the United States because it's so large and there's so many regions. All
right, I want to slow down here. I want to talk to our listeners so we can understand Bitcoin at a little bit of a 101 level. We've gone down IPOs, SPACs. I want to talk about Bitcoin treasury companies and ETFs. So can you explain for our listeners what is a Bitcoin ETF and how is that different from owning shares in a Bitcoin treasury company?
Sure. So ETFs are exchange traded funds. They're products and tools created for investors in order to have exposure to a specific product, a basket of products or assets, which can include, so there's ETFs for like the S&P 500, which are managed by different asset managers. So BlackRock, State Street, Fidelity, Goldman, they all kind of have their own ETFs. So those ETFs can be very bespoke. They could be general, and it just allows retail and institutional investors easy access to exposure, right? So a Bitcoin ETF is effectively just an ETF that you can buy on your Schwab account or E-Trade or whatever. That gives you access to Bitcoin, exposure to Bitcoin.
But you're not actually owning real Bitcoin.
You're not actually owning real Bitcoin. You own a share of a fund that owns the Bitcoin.
But the fund doesn't always own the Bitcoin, depending on the ETF.
Meaning, you mean like they don't hold custody themselves?
Right. So some of these ETFs might be trading futures of a Bitcoin versus actually owning the Bitcoin themselves somewhere else.
Yes. If the ETFs are have exposure to futures and derivatives, then yes. But there are ETFs, like Bitcoin ETFs, that are only for spot Bitcoin, and they're not allowed to do all that other stuff with derivatives and futures. But yes, so you have to know.
You have to do your research
Correct.
on what, and I know this is now the case as I'm diving deeper into the ETF world, specifically on Bitcoin. You need to know what type of ETF your Bitcoin ETF is, because they are not all created equal.
Correct. And some of them have different management fees, although those management fees are compressing. But Morgan Stanley has an ETF for Bitcoin, Bitwise Asset Management, Fidelity, Grayscale.
Goldman Sachs has one.
Yeah,
now.
Goldman Sachs is starting an income Bitcoin ETF, which is, that one's more derivatives, selling options to generate income, caps your upside, but generates income. And there's, half a dozen others. I'm not endorsing one or the other. I think, do your own research and just make sure. My advice to anybody who's looking to get exposure to an ETF is effectively just go with the one that's cheapest. It's gonna say like, what is the management fee? It's gonna be between 20 basis points and 40 basis points. It's all just exposure to Bitcoin. Go with the cheapest one.
So let's pivot into deal flow. So where the theory meets the woman listening on her commute, we want to just dive into deal flow. So without breaking client confidentiality, what is the texture of deal flow you're seeing right now? It sounds like a few years ago, there was a lot going on in the Bitcoin mining space. There's definitely some reallocation of those companies right now. But where are you seeing volume, and what categories are kind of heating up versus cooling off?
Yeah. So Bitcoin mining definitely cooling off in the public markets. There's still some M&A in the private markets happening, but really it's for exposure to real estate that has access to energy. And all of those folks are trying to sell to the data centers. And we talked at length about that. Where we're seeing a lot of activity is really broadly across the space, right? So exchanges, service providers like accounting firms, some banks and custodians. There's some payment companies. There are like these crypto companies that are validating the network of different ecosystems of different layer one tokens, who they generate fees for that, and they're all trying to figure out what to do. And so what's really driving a lot of this is like, one, interest in the long tail of crypto assets is waning. And I kind of saw this coming a few years back. It's like, if you think about any new product, like technology or industry or idea that's cool and interesting and has potential, a ton of people come in. It's a gold rush, right? And the people who come into the gold rush, they will do what they can to find the gold and mine the gold. But there's not going to be a lot of winners. Eventually, some people get better at it than others, and there's going to be consolidation. This happened with the dot-com bubble. Like, how many dot-com companies were there back in 1999 before the whole thing blew up? But what's going to emerge is a few winners, right? And we've kind of started to see that in crypto with Coinbase, with Bullish, BitGo, Circle, for example. But these medium, smaller sized companies that tried to go find gold, didn't quite strike it, are now facing a dilemma, especially now that the Genius and the Clarity Act have passed. That has really opened the door for TradFi, traditional financial companies, banks, insurance companies, to play in the same sandbox. Mm-hmm. So like, up until pretty much now, right, through Clarity, Morgan Stanley, Goldman Sachs, JP, these big firms, they couldn't play in it, and they didn't want to risk any sort of reputational or regulatory issues.
No one wanted to be first.
No one wanted to be first. And they're like, let these, crazy people, these crazy crypto guys, take the risk and see what happens. We'll learn, from them down the road. The hard part was never really the tech. Now, I'm not saying the blockchain tech is easy, right, to manage. It's complex, et cetera. But if you're Morgan Stanley, you have devs that can figure it out.
Yeah.
So what really is the tough part? Well, it's regulatory. making sure you're not breaking any laws.
Which, by the way, are being written in real time.
Exactly. That's known as the Clarity Act is defining how market participants can play in crypto. They're defining the rules as we speak. And these big firms, by the way, have a lobby right now in DC trying to bend the rules their way. And the crypto industry has a lobby trying to bend the rules their way. And they're, fighting to meet in the middle. They're almost there.
And then we see the crypto litigators in the space literally sitting down with policymakers in DC explaining to our government what is going on in the crypto space, and they're helping shape the laws because the government policymakers don't fully understand what's going on. It's too complicated and so over their head. So we are in a very interesting time right now.
Totally. And these policymakers have a stack of things this big to do. Crypto has always been at the bottom, but recently has kind of climbed to the top, particularly with this administration.
We have a very crypto-friendly administration right now.
Very crypto-friendly administration. But I think now both sides of the aisle are pro-crypto. And I would argue that the Democrats lost in large part, not fully, but in large part, by going against the crypto industry. The crypto industry pretty much fully backed Trump simply because he said, hey, we're going to create rules for you guys to play fair in US markets. And the Democrats said no. They learned their lesson, and now I think they've come to the aisle and are supportive of crypto. I lost my train of thought on where we were going with the big firms.
Yeah, the big firms.
So the regulatory part was hard. That's figured out pretty much. And then the distribution is the second hard thing that happens. Like, how do you find users to use your product or use your technology and generate revenue? And most of these smaller companies just haven't been able to get there. And so, but guess who has those users? Guess who has those consumers and depositors? The big firms. They have millions and millions of users. And so they can figure out the tech. Now they got the regulatory. And guess what? We have the user base that we can sell the product into. So the medium and small companies in crypto are now facing this existential crisis where it's like, I'm going to have to compete with JP Morgan or sell to somebody or consolidate the space in order to be able to compete with them. Because if you don't, I think if you're a shareholder or a CEO or founder of these like medium-sized companies or small companies, you're kind of facing big fat zero in 3 to 5 years.
I mean, the reality is they don't have distribution. And I think that's the biggest unlock in the next 12 to 24 months is distribution to the next wave of crypto investors. Right now, our crypto user demographic is about 50 million people. It's mostly men. It's mostly men under 40. And that next unlock for, the trillions of dollars that we're looking to see move into the market is going to come from normal people, everyday people. That's why we have this show, right? Because there's nobody out there talking to everyday people. There's nobody, when I started getting into the space, there was no one for me to go to that sounded like me, looked like me, talked like me, and talked about the space in a way that made sense. And I think that is this next wave of adoption. So when we see the big institutional players getting into the space, I get excited about it. I get excited. It's a little antithetical to why I like the cryptocurrency, why I like Bitcoin in the first place. But I get excited about the Genius and Clarity Act because it does unlock this next wave of consumers that can get into the space and feel more comfortable and actually have access where they might not have had access before for any number of reasons.
100%. I get excited too. And it was only a matter of time before these big banks came in and big firms came in and kind of took over the industry. Really, there's so much to unpack here, but really like crypto at the end of the day is, in my view, there are some products you could build on it that are kind of crypto specific, but really what is crypto? It's a blockchain, and it's an upgrade to the back end financial infrastructure that powered our financial markets, right? So instead of having to have humans do reconciliations and accounting and settlement, and you have to wait 3 days to actually get your money from a foreign entity if you're transacting with a family abroad, and like getting charged 5% fees.
Yep.
Like
It adds up.
all that infrastructure is there today, but it's old and it's clunky and it's been put together over decades and decades and decades. And now we have this thing called the blockchain that completely upgrades that back end infrastructure and makes it super efficient.
How has the Genius and Clarity Act changed your business, or how do you think it will change your business in the next 12 months?
Oh, very good question. I think it is causing a lot more M&A discussions, which is great for us. There's going to be consolidation. We help advise companies on selling their business or acquiring businesses. I also think it forces other companies to say, hey, we need liquidity. And so maybe we're large enough to access the public markets. We're not going to make it via IPO. So let's look at alternative paths, which can be these SPACs, or, I mean, I have the position that you could also do a reverse merger into a digital asset treasury, these DATs. I don't know if your users have heard what DATs are.
Let's explain what is DAT.
A digital asset treasury. There was this, craze last year where different, folks, sponsors in the industry wanted to raise capital to go put a token into a public company and hold it as a treasury. And I think you asked this question earlier, what's the difference between a digital asset treasury and an ETF? It's effectively the same thing. You're just holding crypto in a publicly traded entity or vehicle. The reality is that the DAT tends to be more expensive to hold. However, on the flip side, there's a management team there that's trying to generate value through staking, through different financial engineering. So there is like a trade-off there. But yeah, so what DATs are, they just have a ton of Bitcoin or other crypto, ETH, Solana, et cetera, on their balance sheet, and they're publicly traded vehicles.
What is one thing happening inside the digital asset deal market right now you wish more sophisticated investors understood?
I think, just going back to Bitcoin I think Bitcoin is still bucketed with the rest of crypto. And I would argue that Bitcoin has separated itself from crypto on its own. I mean, it is technically a cryptocurrency, but what Bitcoin has emerged as is a true store of value and what I consider probably the most sound money ever created by humans. And what is sound money? There is, I don't know if you can pull up like a cool infographic, but there's, for those out there, if you just Google image sound money, there's tons of infographics that kind of show a kind of like a grid with 3 columns. First column is Bitcoin, second column is gold, and the third column is fiat. And fiat just means, the dollar, US currencies. A fiat can be like the British pound, it could be the euro, it could be, Chinese yuan. That's kind of fiat currency. And it walks through what are the elements of sound money. And I'm not going to remember them all, but it includes, decentralization, it includes divisibility, it includes, ability to recreate or inflate, portability, and there's like 6 others. And Bitcoin effectively hits every single one of those assets. Every one of those elements. Gold hits most of the elements. But the big problem with gold is that it's not portable or easily divisible. With gold, if I am getting, if there's a tyrannical government that is trying to take over and they can come for my assets and my gold, I can't run away with $1 million of gold in my pocket. That's really hard to do. But I can do that with Bitcoin. And fiat, I mean, I don't even want to spend time there.
Yeah, we won't spend time on that. That's not what this podcast is about.
But to just kind of round up on your question is, what do I wish institutional investors understood that they really don't? There's more and more that understand it, but I still think people believe or think that Bitcoin is not real, and you're still seeing FUD from time to time on it. I think the biggest downfall that crypto has is just the length of time it's been around. It's been 15 years.
It's a baby.
It's a baby. It's a baby in the grand scheme of things.
Okay, you told Pierre Rochard that not holding Bitcoin is becoming irresponsible for corporate treasurers. That's a really big claim.
I stand by it.
What is driving that conviction, and what are you seeing from the companies that have actually made the move?
So I think it goes back to, it ties nicely to your previous question, is like, what do I wish institutional investors, knew or understood that they don't? Again, Bitcoin is going to serve and serves as a store of value in the face of an inflationary environment, which it just happens to be that the United States is always in a state of inflationary environment, right? The CPI, the consumer price index that they try to maintain to, and that they market to the public is like 2 to 3% a year. We're well above that right now in CPI terms, but that CPI calculation literally takes out and adjusts for like sometimes, groceries and meat and like things that you actually
That actually
buy
move the needle.
that actually move the needle. And they do that so that they can have a headline number that doesn't seem crazy. But when you add all of this back in and you actually take the actual consumer price index based off of everyday things like groceries, gas, rent, mortgage, homeschooling and nursing, whatever, all the real expenses that every day and your listeners, I'm sure, have to deal with, the actual inflation rate is like 8 to 10% a year, which is insane. And then if you also compare that to what they say, like the average equity risk premium is in the markets, which is like how much the S&P earns every year. I'm sure maybe some of you guys have heard this, is like 8% a year. And then you kind of put the two together and you say, wait a second, the actual inflation rate is 8% a year. And the S&P's growth rate is like average 8% a year. So hold on, the S&P's growth is just inflation. And then you understand how the markets work. And, money managers and individuals and investors, their goal is to beat the S&P. And by transitive property means their goal is to beat actual inflation.
Which means you're not actually, we can unpack that, but we'll just let that sink in.
Let that sink in.
Let that sink in.
If you're not, they've lied to all of us and said, save your money, put it in a bank account that's safe, earning, 0.25% APY. But what's actually happening is they're deflating the value. And what's actually happening is they're stealing your time.
This is a great segue for my next question. You framed Bitcoin as this generation's generational wealth play. Gold for grandparents, homes for parents, Bitcoin for us. Tell me the version of that pitch you'd give your sister, mom, or future kids. Take out the finance vocabulary.
Yeah, I mean, it's funny. Yeah, I kind of went through it earlier. But like, if you think about, the time that you spend working and you work your butt off, you're, I don't know, earning $30, $40 an hour, sometimes minimum wage, really depends. Obviously there's a huge, range here, but like that is your life. And that is your time that you trade instead of spending it with your family, taking care of your kids, doing things you enjoy, walking on the beach, working out. And then you listen to what they say, you save your money responsibly, but then all of a sudden your gasoline is $10 a gallon. Your, your schooling costs are now, I don't know, what is it, like $100,000 a year to go to like an
insane
decent college. And you now have to work more time in order to meet those costs. And it's like, when do I have time to live? There's no more time in a day. You can't create more time. So we need to, and by the way, have created Satoshi in his or her or their, greatness, created this tool called Bitcoin, which is a lot more sound money through cryptography, in order for you to take back your time, because Bitcoin is perfectly scarce. And as we know how markets work, money flows into risk assets that tend to be more scarce, right? Like gold has had a crazy appreciation over the last several months because central banks are accumulating gold and it's scarce. And so it drives the price up. That is what Bitcoin is. Bitcoin is a sponge for inflationary pressures, which means it appreciates in dollar terms faster than inflation.
It's scary. I mean,
scary to think about.
You think about people like working corporate jobs, blue collar, white collar jobs, their pay increases are not going up in line with inflation. College prices have like doubled, tripled since we graduated. Things are just really not looking good. It's very scary, and it's just accelerated, I think, coming out of the pandemic.
It is scary. It is especially scary if you don't understand why it's happening. But it's less scary if you take the time and understand how the system works and realize that actually you can take advantage of the system. And there are tools available to you as a saver and really an investor. You should be an investor right now and not a saver, because we're facing inflationary pressures. And so if you get educated about that, well, just like anything, right? If you understand it, right? Like a big monster that you actually know, it's got feelings and you're like, it's not that scary after all. Like that's what this is. And you have an opportunity right now to understand it and hopefully be a little bit less scared and nervous. Just say, hey, this is how it works. And there's a way to address it.
And you guys listening are doing that exactly right now by tuning in, because knowledge is power and you got to start somewhere. Don't be intimidated. All right. So there is a $6.6 trillion deposit war in Washington right now between Coinbase and Jamie Dimon over whether stablecoins can pay yield. This actually came up at a dinner I was at last night for Consensus. Translate that fight. Who wins? What's going on? Like what is going on here?
Yeah, I mean, that's the battle that I was kind of talking about earlier, how you got the big banks lobbying on one side and the crypto companies on the other side. And it really all came down to what's called stablecoin yield, otherwise known as interest to you as a depositor. So what happens today in traditional banking, you have a Chase bank account, you put your money in there and they offer to pay you 0.25% APY, 25 basis points or 25 bips in banking lingo. And that's how that's how they make it work. They take your money and they lend it out at higher rates. Mm-hmm. And so the lower your interest rate is, the larger their margin is, right? Put that aside. The crypto industry has now created what's called, stablecoin. And a stablecoin is almost like an ETF for digital US dollars, right? So you hold this thing called a stablecoin. It's just a digital representation of a US dollar. The stablecoin issuers, like the companies like Circle, for example, you can think of them as like pseudo banks, right? Because you deposit your money into Circle and they give you back a digital version of it. They're holding your money, just like JP Morgan or just like Chase. So they kind of look the same in terms of what they're doing. But what Circle does, instead of lending the money out to people who need a mortgage or a car loan or a credit card loan, they go and buy US Treasuries. US Treasuries are just IOUs to the government that investors purchase so that the government can borrow and says, I'll pay you back whatever in 10 years, 20 years, 30 years. These stablecoin issuers collect 4 to 5% interest rate on the stablecoin, and they keep it currently. But they want to actually pay the depositors, us, people who use stablecoins, that interest rate. And the big banks see that as a massive, massive threat. Because if I'm a user, right, if I'm a depositor, and I have $10,000 that I want to put into a bank account or a stablecoin account, which is effectively a bank account, and this stablecoin account is offering to pay me 3%, and Chase is offering me to pay 0.25%, where do you think I'm going to put my money? And so the big banks are afraid that there's going to be a massive withdrawal of capital from their bank accounts.
Which would completely collapse our entire monetary system.
Yeah, I mean, very possibly so. So like on the one hand, I'm pro the stablecoin yield being able to offer, because it's like, hey, this is financial innovation. And this is like a capitalistic environment. Like let them play, let them compete. But then on the other hand, our financial system is so complex and fragile that if you do that, you have to do that very carefully so that it doesn't all unwind right away and cause a financial crisis.
For a 38-year-old woman who's listening, she has a successful business. She has $500,000 of cash sitting in a money market fund. She knows she should have some Bitcoin exposure, but she's never bought any. Where should she start? What should she watch out for?
Yeah. I mean, in the US, I think the simplest way to start is open up a Coinbase account and buy your Bitcoin on the Coinbase. But I mean, full disclosure, Coinbase has higher fees than other places, but that tends to be simpler. It's an easy version. You can also do Kraken, which is a little bit of a cheaper way to do it, but Kraken's not available in all states, most states, but not all. You can't do it in New York, for example. But I would start there. And then in terms of, how you would allocate your capital, I mean, I have like 30% of my net worth allocated to Bitcoin, which don't listen to me. Please do not take that financial advice. I really believe in the asset class, and I believe in its, hedge against inflation. But I think, many financial advisors, including the Morgan Stanleys, Charles Schwab, and Goldman Sachs, are suggesting anywhere between a 5 to 10% allocation in Bitcoin. So, 50K, 100K, 25, 50K to Bitcoin. And then, I think index funds are okay. ETFs, exposure to the, NASDAQ, S&P 500.
Bitcoin or crypto?
Bitcoin.
Self-custody or ETF?
Depends. Probably for most people, ETF.
Spot ETF or Treasury company?
Spot ETF.
Hard money or soft money?
Hard money all day.
De-SPAC or traditional IPO?
Depends. Big companies, you have a way to do it. Medium to small size companies, SPAC is the answer.
Where are better deals happening right now? Public markets or private markets?
Public markets. Although there are some crazy private market deals. It just depends on where you are.
Strategy or ProCap?
Pass. No, I'm kidding. They're both great.
Who would you rather take a coffee meeting with this week? Adam Back or Pierre Rochard?
Oh, they're both great. I know them both. I haven't caught up with Adam in a long time, so I'd like to say hi.
It'd be an interesting time to catch up with him.
Yeah. Oh my gosh.
The New York Times article that just came out.
So bogus. Adam's not Satoshi. Just putting it out there very clearly.
You know what's funny is because I'm so deep in Bitcoin Twitter and crypto news, I didn't even know there was a new article that came out because it's this has been around for so many years. It's nothing new.
For so many years.
But the New York Times now has I don't know, they have a lot of pull, I guess.
It was honestly, my opinion, at best, it was irresponsible by the journalist. And I think they're a respected journalist. They were the journalists that brought out the Elizabeth Holmes story. Yeah. But there was so much more research they could have done. And it's very obvious that Adam's not Satoshi to anybody who knows. So Adam now has extra security.
I know.
Because of it. Just that's sad.
I mean, I read the whole article. I think that it's definitely obviously not somebody with a lot of experience in the crypto space or fintech or any of it. And they for sure went on a bit of a wild goose chase. And it got him a lot of impressions and press, and that's what the goal was. So
again, mainstream media, this is why we trust folks more like you, Emily, than the New York Times.
Decentralized media.
That's right.
Genius Act or Clarity Act?
I think Genius Act is interesting. Clarity Act creates a whole opening to the crypto industry, but I'm still unsure about how I feel about the stablecoin yield.
End of 2026 prediction for Bitcoin.
Ooh.
150K, 250K, or something else?
I think something between 125 and 175. I'm a permable on Bitcoin, but we're seeing liquidity drop into the entire market. Bitcoin right now is also benefiting from that. There's a massive AI boom right now. I know this is not about AI and infrastructure, but there's some supply chain companies in the AI space that have gone up 200-300% in the last month. And that's going to flow elsewhere as people take profits and figure out where to allocate.
New York or Miami?
Ooh. So I'm trying to make the move to Miami.
We're here for it.
I know. I'm going to have to say Miami.
I agree.
But I love New York. I've been there 15 years.
New York's great. It's formative. Bitcoin conference or consensus?
Ooh, I'm a Bitcoin. I love the Bitcoin conference and I have so many friends there. So it's a great time. However, I would say this year there's more energy around the consensus.
All right, you guys, that was your Bitcoin Capital Markets starter pack and exactly the kind of conversation Stacked exists for. You can find Christian on LinkedIn. You can learn more about Cohen Company Capital Markets at cohencm.com. If this episode made you think differently about Bitcoin and about how deals actually get done, send this to an ambitious woman in your life, because soft power runs on hard assets and Bitcoin is the hardest asset that there is. I'm your host, Emily Dempsey. This is Stacked, the show about helping you become your own best asset. If you are not already subscribed, please subscribe to us on all of the channels. Your likes, comments are meaning a lot to us right now as we continue to grow the show and help keep us going. We'll see you next week. That's a wrap on this episode of Stacked. If this one added value, share it with someone who's ready to level up their financial life. Subscribe so you never miss an episode. And if you're feeling generous, leave a rating and review. It helps us keep the show going and reach more people who are serious about becoming their own best asset. You can subscribe to our newsletter at www.stackedassets.co for weekly intel on Bitcoin markets, business, and living well. Follow along on socials at Stacked Assets or my personal at Emily Dempsey for more on Bitcoin business and building the life you actually want. I'll see you next week. Stay stacked.